As tariff uncertainty fades, will US shoppers open their wallets in 2026? This is Sectors Up Close, and we're talking about US consumer stocks. Nerves about the possible impact of President Trump's tariffs on prices weighed on those stocks in 2025, but investors' worst fears never materialised. Although consumer discretionary is dragging on the S&P 500 so far this year, it's down about 3% year to date. So could 2026 turn out to be the year consumers again feel confident splashing the cash? Sarah Henry is a portfolio manager at Logan Capital Management. Sarah, we've had a mixed bunch of data recently as far as the US consumer is concerned. Resilient consumer spending, but also weak jobs figures that might make those shoppers reluctant to spend. How do you read the data?
Yes, so we're going to have another huge week of data this week. We're going to get payrolls and CPI, which is going to inform inflation and retail sales, all of the spectrum of what drives GDP and rates. So you're right, we have a paradoxical consumer that is feeling some anxiety about tariffs and inflation and job losses, but they continue to spend almost relentlessly.
There has been a lot of talk about the K-shaped economy. Is that what we're seeing here?
Indeed. So we're seeing definitely calling out in these different reports from different companies that they're saying that the lower income consumer is struggling here and the higher income consumer is feeling pretty flush from real estate and the stock market. So to the extent that that continues, we will continue to see better performance in the higher income consumer, and companies are very keenly focused on attracting these different cohorts.
Do you think then that the way to play this sector this year is to pick and choose and focus on those companies aimed at the luxury end of the market?
I think it's even more interesting than that, in that right now we are dealing with all of these advanced AI technologies, and we've seen and heard about all the investments that the hyperscalers are making, and we are seeing it rain down on top of all of the companies and seeing it all deployed across different types of functions in these companies. And this is really a story about scale advantage, and companies that have made the investments in these technologies will be the winners. So Walmart is a good example that typically that is known as a lower income cohort for spending, and they've been attracting consumers significantly who make $100,000 or more, and that's unusual for them, and it's really been driving returns for this company and for the stock.
If employees see AI rolled out in their workplaces, though, isn't that making them nervous about their jobs? If people think they might be replaced by AI, they're going to stop spending, aren't they?
I think that's a fair consideration, but I think productivity is here to stay, and it's going to add to GDP growth. We've already seen AI-related capital expenditures growing the economy, which is, of course, 2/3 of GDP is made up of consumer spending, and AI-related CapEx has contributed between 50 basis points and 130 basis points to US GDP growth in 2025. And we expect that that will continue, and AI could permanently raise GDP and productivity over the long run.
How important is the Fed's role in consumer spending? How important is it that rates do come down and boost Americans' disposable income?
It's absolutely important. It's critical at this juncture. The US housing market has become very unaffordable. Affordability is something that policymakers and consumers are focused on, and we are definitely at sort of an apex in terms of the Fed funds rate, because that's going to stimulate affordability. It's going to stimulate cash flow in the economy. So there's a lot of pent up firepower in terms of the ability to move the needle on cash flow in the economy.
If those cuts don't materialise then perhaps as much as the market's hoping, do you expect consumer stocks to be particularly hard hit?
That's a good question. Specific ones, yes, but other ones will be beneficiaries. A name like TJ Maxx, for example, is not dependent on rates in particular, but they do tend to benefit when consumers focus that cash flow that they would be spending on housing, on goods. So we're seeing a little bit of a renaissance in spending on goods as people have burned through what they bought during the COVID era. And we're seeing a little renaissance of people, retrofitting their homes and filling pantries again.
That was Sarah Henry of Logan Capital Management. Don't forget you can watch more videos on Reuters.com.